Well, President Trump has been critical of the Fed and Chairman Jay Powell, his nominee, for raising interest rates. That's a hot topic at the Fed summit this week in beautiful Jackson Hole, Wyoming. Steve Leisman joins us now with a couple of people who might agree with the president on that point. Steve.
Yeah, Tyler, sort of an odd situation here. We have been talking to the Fed Up group. They're the protesters who have been opposing plans by the Fed to raise interest rates for, this is now their 5th year up here at the Jackson Hole Summit. And I'm joined by Shawn Sebastian. He is the director, and Marshall Steinbaum from the Roosevelt Institute. Shawn, let me start with you. The way Tyler put it is kind of odd. You agree with the president about not raising interest rates?
So I'll just tell you our position since we first met in 2014,
right.
Like 4 years ago, is that the Fed should not be raising interest rates until we see wages going up with productivity. And there's no reason to raise interest rates when the Fed is still undershooting its inflation target. We've been consistent for 4 years. Donald Trump criticized Janet Yellen during the election for keeping rates low. Now he's president and he's criticizing his own pick for raising rates. He's completely incoherent and self-serving.
Okay.
So I'd say on both counts, we are being exactly who we are and being exactly consistent.
So the topic of this conference is interesting, and I don't know if you guys have had an effect on this, but this idea of monopoly power and the effect of the rise of these big firms, especially these big tech firms, and the idea, it's not proven yet, and Marshall, you've done some work on this, and maybe you explain the general idea, which is it's not an out there idea. There are many mainstream economists who are thinking that maybe these monopoly firms are keeping a lid on wages.
Yeah, that's right. I mean, what Shawn said about how there's been slow wage growth in the economy has really caused a sea change in the economics research that's been done to try to explain what determines wages in the economy. And one of the things that people have focused on is exactly this rise of market power on the part of employers. So when employers exercise market power over their workers, that's called monopsony by the econ wonks out there. And what we found, so what my research finds specifically is that labor markets in which employers are concentrated, in which relatively few employers account for a large share of hiring, those labor markets have lower wages, and moreover, many labor markets in the economy, the majority of labor markets in the economy are characterized by very high concentration.
And it's increasing, right? The number of bigger firms, and it also has this winner take all. I just want people to know, this is not an out there idea. There were papers presented on this at the American Economic Association annual conference, and there will be several papers presented on this inside. Shawn, you have a graph on the back of your shirt, which is, we can't turn you around because of all the wires and everything, but it shows that we've had productivity go like this, but wage growth go like this, if you guys don't mind my air charts out there. Right. What's the gap right there?
I mean, frankly, the gap is that workers' bargaining power has been undermined systematically by the dismantling of unions, and market power has made corporations more powerful, more wealthy, and have greater bargaining power than ever. So when we're talking about bargaining for wages, workers don't have collective bargaining power, and oftentimes an employer is the only game in town. If you don't take the wages, there's no one else to go to.
Marshall, you have in one of your papers, you have a map, and the map shows a lot of red in the country, and that red is not for republicanism. Although it does sort of follow those areas, it's for market concentration. And the only places where workers seem to have a competitive edge or the ability to bargain is along the coast. And the rest of the country, according to your work, is really, what is the right way to put it, subject to a single or very few employers.
Yeah, and I want to emphasize that that's not how the economy is supposed to work according to the economics received wisdom and according to the models that the Fed has been relying on when they make their forecasts about how there's supposed to be an imminent wage price spiral. So this large block of red in the whole labor in the whole country is telling you that the labor market works differity than the way economists have been assuming it does.
Is it a failure of antitrust legislation?
Among other things, yes. I mean, not
so
a
wait,
failure.
let me follow that up.
Sure.
Should you guys should Facebook and Google be broken up? I think that's the kind of major firms we're talking about that's happened.
Well, I think there's large degree of market power throughout the economy that's
Right.
characterized by the tech sector. Amazon, in particular, is a company that we know engages in exploitation of its workforce and in inducing its suppliers to also exploit their own workforces. And I think antitrust absolutely needs to play a role in making the economy work the way it's supposed
So,
to.
Shawn, you say no Fed rate hikes until wages match productivity growth. They're at 2% now. Should they be cutting rates? What's your thinking?
I think at the minimum they need to be stopping rate hikes. They're talking about doing a rate hike in September and one in December. Neither are necessary.
And let wages catch up. And
Let
you
wages
think they keep
catch
going
up.
with productivity.
Yeah.
Folks, that's a point of view here from the Fed up, folks. And I don't know how many inside of the Fed officials agree with that, but there are some who have some concern over the rise in rates here. And they are going to be considering, Tyler, this issue of monopoly power over wages and what it means for monetary policy.